Good Thursday morning, Market Chameleons, and everyone joins us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, please take a look at the shared screen. The disclaimer: be aware that neither Dimitri Pargamonic or Will McBride or Market Chameleon are registered investment advisors or broker dealers. If you are searching out investment advice, please reach out to a registered professional. This show is for informational purposes only concerning Market Chameleon's tools and features presented by this man, Dimitri Pargamonic. How you doing, D?
Good. Thanks, Will. Yeah, good morning, everyone. I'm going to share my screen. A quick note to anyone joining us for the first time. Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, type it into that live chat on YouTube. Will's keeping an eye on it. He'll let me know and read them back to me. And if you have a question and could help other people as well, they may have the same question or point something out nobody thought about. To give you guys a couple minutes to put in those questions, we're going to start out taking a look at our pre-market report to see if we could get insights, what's going on in pre-market hours, and then we'll move on to the questions. Okay, so pre-market report over here, these are stocks trading in pre-market hours. And up top, you'll notice we have this calendar view, and this gives us a summary of what happened in the pre-market hours in the last week. And this allows us to compare today's activity versus the most recent activity to see, if there are any trends, how we compare today, if something is happening unusual. And so far today, here we are on April 11th, we see that there are 597 stocks trading higher in the pre-market, 245 stocks trading lower. We have 159 million shares trading on up volume versus 50 million on down volume. And we have $5.4 billion worth of stock trading higher, $607 million worth of stock trading lower in the pre-market hours. So that indicates that there is a bullish lean so far in pre-market trading. Let's take a look at it from a couple more perspectives. Then we're going to take our questions, and I'm going to scroll down a little bit. And now we have this granular view of what's going on in the pre-market hours. We see the stock symbols, the price changes, volume alerts, what's happening in pre-market. And we have a list of our most active stocks, biggest percentage gainers, biggest percentage decliners, and just looking at the count, 89 stocks made our biggest percentage gainers list, 25 on our largest decliners list. So that also indicates that trading activity is leaning more towards the bullish side. Now, to make it onto this list, we do set thresholds because stocks in the pre-market could have very low volume or low liquidity. So if the stock meets that threshold, it can make it onto this list. But that does include small cap stocks. It includes ETFs. Could be a leverage product. It could be an inverse ETF. And to narrow down this group, to narrow it down to a small group of stocks, we could use our filters. And that's what we see here above the table. If you have a watch list, you created a watch list because you just want to follow certain stocks that are on your watch list, you can filter this report by your watch list. We're going to use this filter here in our example, the ETF filter. And when you click on it, you get to select from different ETF options, right? Different ETFs. We're going to use the first one, SPY. I'm going to click on that. And when we click on SPY, the report gets filtered by stocks that are holdings in SPY. So now we narrowed down our report to the S&P 500 stocks, okay? And here we see 5 made it onto our biggest percentage gainers list, 3 on our decliners. So that's a little bit of a mixed bag, slightly more bullish than bearish from that perspective. But every way so far we looked at it, we looked at it from 3 different angles, kind of points to the same thing, that the trading activity in pre-market so far has a bullish lean. So we gave it a couple minutes. Well, if you have a question, I'll take one now.
Nothing's popped up yet, D.
Okay. So we did a webinar actually Tuesday. I'm going to go to SPY for my default example. And there was a question maybe left over. We could take it now, but it had to do with, I'm going to come here to the multi-leg trades section, and it had to do with stock contingent trades. And when we look at, option trades and option orders, so this is our multi-leg trade analyzer. This is looking at actual trades that happened yesterday in SPY. We're not open yet today. This is yesterday's report. And it's looking at the vast amount of data on the trade tape and organizing and preparing and analyzing, making interpretation of, okay, well, here are multi-leg trades, here are stock contingent trades, and then it displays it here of what is the most likely strategy that happened. So, so it's finding put spreads. Oops, clicked on it. Certain other trades, here's a put spread, this involved 14 legs. We'd have to take a look at it, ratio, put spread, and so forth. And when we do when we look at multi-leg trades, sometimes a multi-leg trade could have a stock component. In other words, we've seen if you traded strategies before, you could enter in a call spread or put spread where you need a execution on both legs simultaneously, right? You're not getting one leg and then trying to chase it and doing the other leg, but you want a call spread and you put it in simultaneously. And sometimes there are strategies that you need the stock component as well. And that's what we talked about for hedging or specific strategy. So I'm going to kind of look here and let's find one. I'm going to go through. So here's one at 12:22:25. There was a conversion reversal because we found a stock component to it, right? So this is April 19th, 500 call, 500 put with 600,000 shares of stock. So we interpreted that as a conversion reversal. So here's the, here's the trade over here, 12:25. These are the details of each leg. Here's the put, here's the call, and here's the stock component that we found that's matching it up. So what's going on here is that there are the software identified there's 3 legs to this strategy. And based on these 3 legs, that the most likely strategy is a conversion reversal. So we don't, a conversion means that you're doing one side, the reversal is the other side. Okay, so that's why it's a conversion reversal. So one side's doing the conversion, one side, the opposite side is doing the reversal. And a conversion reversal is a strategy that targets not directional. So it hedges the directional risk of a strategy and targets the cost of carry. So you have exposure then to cost of carry. And somebody asked, well, if the stock goes up or down, it doesn't matter to it. And yes, that's how the conversion reversal works. You're taking off the directional risk or mitigating the directional risk, and you're isolating it to the cost of carry. Okay, so it's important to understand that as a trader, that you don't think of trades in only terms of direction, up or down. Okay, because if that's the only way you're going to think of trades, as either I have to be correct up or down, then you're really not, I think, at the stage where you should be trading a lot. All right, you need to understand that there's lots of stuff you could do there that are non-direction, and for the most part, as professional traders, you probably want to mitigate your directional risk. All right, so this will be one example we're going to take a look at where we're taking off the directional risk. Okay, and because if you're thinking about it as just up and down, it's you're limiting yourself to where in our experience as professional traders, on the floor making markets, is that as far as directional goes, it was barely anything that was in our portfolio. We usually took off the directional risk. Okay, so let's take a look at this conversion reversal. I'm going to let's open up a new oops. What did I do here? Let me open up a new Market Chameleon. So I would need to come back to this one. So here it is. Okay, I'm going to stay on this, and I'm going to set it up in the options chain. So I'm going to open this up. All right. So we see this is April 19th, 500 put, 500 call. I'm sorry, the strike 500 put, 500 calls, and you could see here they're all proportionally the same. 6,000 in a call, 6,000 in the put, 600,000 in the stock. Okay, so we're going to come here, and I'm going to go to the SPY options chain. We're going to set this up. We'll go to the options chain here. And we are on the April 19th over here. Okay, and I believe we said the 500, right? April, yeah, it was the 500. So here's the 500 strike. Here's the 6,000 on this side. There's 6,000. So let me do one side of it. I'm going to do the synthetic short first, just to show you. So the 500, if I sell the call, right, and I buy the put. So here, selling the April 19th 500 call. So far, I'm using the market price here. Buying the April 19th 500 put. That's the market price. I'm going to run this analysis. I'm not doing the stock component yet. I just want you guys to see what it looks like before we enter the stock component. Okay, so here, this is the payout diagram at expiration. So what does it look like? Well, the stock's right here. Oops. The stock's right here. Let me close this for a second to expand it. So what this is showing is keep in mind, we're only doing options here, that this is a payout diagram of what a selling short stock would look like. All right. So here we could expand it even 20% around. So you could see this is what selling a short stock looks like. If the stock goes down, these are the stock prices. So you can see as the strike prices, as the stock goes down, you're making 1-for-1 with the stock at expiration. And as the stock goes up, since you're short, you're losing 1-for-1 with the stock. Okay. This is what a synthetic short looks like, because instead of selling short the stock, you're synthetically shorting the stock using options. All right. So how would you hedge that delta? Well, if you're synthetically short the stock, you could get long the stock and they all both offset. Right. So you're short the stock with options and you're long the stock with the underlying. Well, they're both going to offset. And if there's a difference between them, then you can make the difference, right? In theory, with no early exercise and so forth, right? Just we'll talk about that later. But given that, at expiration, your stock will get called. So if the stock goes up, you're short the call, right? So you're going to lose on the call, but you're long the stock and your stock will get called away. And then you're flat. If the stock goes down, well, you're long the put, you're long the stock. And then you're going to exercise the put, and then it will offset your long stock, and then you're flat. So then it will be the difference between the two. Now, why is there a difference? Well, keep in mind that there's a cost of carry involved. So it's not like, you could go buy stock and there's no opportunity cost. There's always an opportunity cost. So if you buy, think of it this way. If you go and buy 1,000 shares of SPY for $515, well, now you got to get $515,000 from somewhere, right? And maybe you have it lying in a bank. Well, if you take it out of the bank that's paying you interest, and hopefully you're efficient and you're getting like the, treasury yield or 5.5%. Well, now there's a lost opportunity, right? Because you're missing out on that interest. And you buy the stock, you're using money and the opportunity cost of using money. So that's why there's a difference. There's a cost of carry associated with it. So the cost of carry is moving around. So here you have 9 trading days. So for 9 days, you're going to miss out on interest. In if you bought the stocks, you could synthetically get long the stock. You could do the opposite. But there's a cost of carry component in it, right? It's going to be reflected in the market. So let's see what that would look like. So here, to hedge this, I'm like, oh, well, I have a short delta here, right? Here, I'm short delta. I know that I have a risk, that to the upside, I'm going to lose. To the downside, I'm going to win. I got to hedge this delta off, right? That's my directional risk. So let's do it 1 for 1 with the options. And now I'm going to open this up and I'm going to say buy 100 shares. Oops. Buy 100 shares, and I'm going to keep it at the market price so far. Then we can change it. So I'm going to run the analysis. And then what this shows is, you could see at expiration, right? No matter where the stock goes, at this point, it's not a directional risk, right? This should make that difference between. So what is that difference? That difference is remember, you're not making anything on direction. The stock could go up 1 million. You're not making anything more, or it could go down. You're not making, right? So you're only looking at the cost of carry. Okay. So there's no infinite gain here. So since there's no infinite gain, what you're doing is just moving money from your bank into this conversion reversal and then getting your money back. So the question is, am I making more in a bank, or am I making it more, using this conversion reversal? That's what the exposure is, right? And keep in mind the cost of carry includes any dividends in there, potential hard to borrow, and the interest rate. Okay, so all those are taken into consideration. But between now and expiration, this is expected to make $78, right? And you would have to figure out, well, is the money that I'm using in the bank, if it's making 50 and I can make 78 here, you have to still know some of your risks here. It might be worth it. Or you could do the other, you could reverse it too. So if you're making much more in the bank, then this suggests, well, a reversal will be the other way. You sell short the stock and you get money in, right? You could go buy a treasury. So that's what the conversion reversal strategy is. It's not, doesn't mean that's, there's still risks involved in it. There's some risks involved, but it's non-direction, right? You're starting to think, okay, as a trader, I'm trying to mitigate my direction, unless you have unless that's what the exposure you want, like a long, or if you're trying to mitigate what else is there that I could find by mitigating my risks? So and maybe you could borrow at a lower rate, right? Maybe you can borrow $550,000 at a lower rate and lend it out at a higher rate, which is what's going on here. So let's put in the prices that it was executed at. I'm gonna come back here.
Hey,
So
Dave,
yeah.
we did have a question from Chris, who's asking about, is there a way to scan for reversals and conversions that look like they could be, I don't know, more profitable or have better win rates or something?
So right now, I know. I don't usually, you have to know the risks of it, and we have a scan for discounted stocks, so that's something different to talk about. All right, but I think I will have one. I do have one internally. I don't have one externally, but I think I will put that one out, a conversion reversal. But I don't have one now. Like right now, you'd have to maybe scan for existing ones that traded out there. And the reason I don't have it is that I don't have externally the analytical tools yet in place that it will give you a good a good way to analyze it.
But you could analyze it in the option profit calculator if you want, right?
Well, the problem with the cost of carry is that
Gotcha. All right.
Either you have an interest rate component, and you have a dividend component, and then you have a potential hard to borrow component. Okay, so I don't have all three of those in there. So the options profit, the Black-Scholes model doesn't actually have a component for hard to borrow, because when it was created, that didn't even exist. So I'd have to create a model. I have to create an amended model, right? So I'm taking the original model and then I'm amending it, and that's the hard part because I have to describe to people why it's amended and how it's being how it's acting.
Gotcha.
Yeah, so the parameters aren't as easy. So let's look at this. So the put traded for $1.15, right? Let's go over here. We're going to change this put price. So the put price, we're going to change it to $1.15 just to see how this one looks. The call price traded at 503. I'm sorry, 1503. So 15, let's go. Probably should have typed it in, but okay. 1503, and the stock, $513.04. Sorry, for some reason I thought it would be easier, faster by, doing this. Okay, so these are the prices. We're going to rerun the analysis, and this is what it looks like. So at that time, it was a little bit like $84. So that's what this was aiming at, the conversion at 84. The reversals So what about the reversal side? Why would they want to pay $84? Right? Why would they want to pay $84? So what happens on the reversal side is that you're buying the call, selling the put, and you're selling short 100 shares. So when you sell short 100 shares, well, what happens? Let's say you did 10, 10, and 1,000 shares, right? Well, what happens is when you sell short 1,000 shares for $513, well, all of a sudden, you sold the stock that you didn't own, and you received $513,000 in your bank account or in your account, your trading account. Sorry. So if in your trading account, now you're borrowing $513,000 and you're paying, in here $84. So you're going to pay $84 to borrow that. But then you have to do something. If you're borrowing it, then you're like, okay, well, if I take that 513,000 and I find a treasury bond, that expires maybe in 9 days, how much am I going to make on that treasury bond? Well, maybe you're making $100. Maybe you found a great treasury bond that, that's, U.S. Treasury, and you're willing to take that risk, or maybe you have a broker that pays you a good interest rate, and you're like, okay, yes, I'm going to lose $84 on this. I'm going to lose $84. Let's do the reverse of this. Because why would somebody want to do it? That's the question. Well, why would somebody want to do it and lose money? Well, keep in mind, you're a trader, right? You're constructing strategies, right? So now, like, whoa, wait a second here. I'm down, this much, no matter where it goes, right? No matter where it goes, I'm going to be down. So what happens here? It's actually 216. Okay, so what happens here is the following: you're borrowing money with this reversal, right? You're borrowing. This is when you borrow money. If you borrow money at credit card, you're going to pay interest. If you borrow money from a mortgage company, because you want to buy something, and you're going to pay interest. So that's what you're doing. You're borrowing money at a certain rate. So if you're borrowing that money, then you should have a good idea of saying, I could put it somewhere that I'm going to yield more, right? That if I'm borrowing it at X percent, and it's going to cost me $200, where I could lend it at, X plus something else percent, that is going to yield me $300, and I could make the difference. This is what's going on. That's why the other side would do the reversal, right? Because they're going to be borrowing money. You're going to, in a reversal, you're going to bring in, right? You're going to bring in that amount that you shorted. Okay, so that's how this works. Hopefully that was helpful, because we had a question about that.
Yeah, no, that was really helpful, and it led to a few questions.
Okay.
Actually, Chris says he trades them quite a bit and would love a scanner if that is something in the future the
Okay,
Chameleon
awesome.
put out. He does it a lot, and a scanner would be helpful for.
Yeah, I wanted to do a scanner. Well, first of all, keep in mind, some of these, you have to, you have a dividend forecast in there, so you have to pay attention to that. Because we put it in a forecast, but we don't know the dividend all the time. So that creates the differences between the market and what we think it is, and also the interest rate forecast of the market could make a difference. And then, is it hard to borrow, which those rates are even also, they're not obvious, because those could change from day to day, and they could vary from broker to broker. So these are things with the cost of carry to understand. But yes, if you're some people trade this strat. I mean, I personally would even prefer that to many other strategies. And I think, you know, I will make a screener for it. I just have to think about how to structure that screener so people are kind of aware of those three different components to consider, and a good, calculator to allow you to do those comparisons and analysis.
Yeah, Chris said he'll send over an email with some of the details he looks for. It may be helpful.
Yeah, that would be great.
He does trade them, he says, quite a bit. So Chris, send it over, support at MarketChameleon.com. Everyone have a great day. Awesome job as always, Dima.
Thanks, Chris. Yeah, thanks, Chris. Looking forward to that. I'll take a look at it, because definitely, it helps, when I know like what are the most useful tools out there to concentrate on.
Awesome. Great job, D. Great job, everyone. Have a great trading day. We will see you tomorrow.